Right, today I'll talk about the impact analysis of Trump's reciprocal tariffs on the US dollar, major currencies and the US stock market. Now, President Donald Trump's fair and reciprocal plan set for implementation on the 1st of April 2025 aims to equalize tariffs between the US and its trading partners. Trump has always said, I want things to be fair. So he's trying to do that. If you charge me 10, I'm going to charge you 10, that kind of thing. So this policy is expected to disrupt global trade dynamics, significantly impact the US dollars, other major currencies, like the euro, Chinese yuan, the Japanese yuan, etc., and the US stock market, right? So this analysis that I'm going to present today breaks down the short term before April the 1st, medium term April to July 2025, and long term post 2025 effects based on historical data and past trade conflicts. Okay, so let's go to the US dollars first. Now, the impact on the US dollars from the short term wise, we will probably see an increase in demand. I know right now the US dollars is actually trading down, but I view this more as a corrective structure than anything else. And later you will probably could see the strength coming back again. Now, when it comes to the charts, I'll explain to you in a short later on, how the structure looks like. But basically, I do see in the short term, we could see an increase of demand for US dollars because as tariff introduce uncertainty, investors flee to safe haven assets like the US dollar and treasury bonds. Now, historically, during Trump's 2018 trade war, the US dollar strengthened against emerging markets, currencies as capital flowed into the US assets. Now, expect the dollar index to rise in Q1 2025, reflecting stronger demands. Okay. Now, next is that the volatility from speculation. Investors will speculate on which countries will face higher tariffs first. If tariffs on China, India, or the European Union are perceived as aggressive, their currencies may depreciate, indirectly strengthening the US dollars. Now, Goldman Sachs forecasts increased volatility in Forex markets due to uncertainty surrounding tariff implementations. Okay. Now, for the medium-term effects, probably about, from April to July 2025, stronger US dollars due to higher tariffs. When tariffs increase imports, US inflation rises, forcing the Federal Reserve to delay interest rate cuts or potentially raise rates. Now, for the aspect of potentially raising rates, I don't see it at the current moment. Probably won't see it for a time being but I cannot discount that probability of it happening. But the chances is not that high at the current moment, provided Donald Trump to shock the market with something really very crazy, and the rest of the countries that were affected do the same thing back to US, then things can change from there. Now, high interest rates attract foreign capital, pushing the US dollars higher. So historical comparisons, during the 2018 tariff war, the US dollar strengthened 6% from April to October. Okay. Now, for the long-term effects, right, post 2025, trade deficit could keep US dollar strong in the long run. Now, US runs persistent trade deficits, meaning foreign countries accumulate USD reserve to facilitate trade. Now, even with tariffs, import dependency remains, keeping the US dollars in demand. However, structural de-dollarization trends could weaken US dollar dominance if alternative currency trading blocks strengthen. Now, potential risks of de-dollarization moves: if China, Russia, or EU retaliate, they may increase efforts to trade in alternative currencies like the Chinese yuan and the euro. Next thing is the BRICS alliance. It could shift further away from US dollars trade settlements. We have talked about this. And also, if major oil exporters like Saudi Arabia start trading in non-US dollars currencies, it could moderate US dollar strength in the long run. Okay. Now, what about the impact on major currencies? So let's start off with the euro. For short-term wise, the euro may weaken if tariffs are disproportionately applied to European exports like cars, agricultural goods. So if the European Union exporters will suffer, potentially hurting the Eurozone economy and causing the euro dollar to depreciate. In the medium term, the ECB may intervene to stabilize the currency. Now, if European Union retaliates with tariffs on US tech market, panic could weaken the euro further as well. Now, euro dollar could decline towards parity or below based on historical responses to US tariff measures. Now, in the long term, the European Union could diversify away from the US, strengthening the intra-European trade or trading with Asia. Now, for the Chinese yuan, in the short term, the Chinese yuan will likely depreciate if China faces higher US tariffs on key exports like electronic machinery. Now, the PBOC could intervene to stabilize currency. We have seen this in the past during Trump's first term, and we will probably see it again, okay, if this trade war escalates. Now, in the medium term, China may retaliate with counter tariffs, weakening the Chinese yuan further. So if tariffs cause a slowdown in Chinese export, Beijing may allow further Chinese yuan devaluation to maintain competitiveness. Now, in the long term, China may increase trade settlements in non-US dollars currencies. Basically, the Chinese yuan, the gold-backed settlements with Russia and the Middle East. Now, the Belt and Road Initiative could accelerate Chinese yuan usage globally, reducing long-term US dollar demand. Okay. Now, as for the Japanese yen, in the short term, the Japanese yen strengthens initially as a safe haven currency amid trade uncertainty. So the US yen, the dollar yen, could fall towards 140 levels before stabilizing. In the medium term, if tariffs hurt Japanese exports like Toyota and Sony, Japan may intervene to weaken the yen. The Bank of Japan could maintain ultra-loose monetary policy, keeping the Japanese yen weak. In the long term, if global trade persists, all right, global trade conflicts persist, the Japanese yen remains a long-term safe haven, keeping demand pretty stable. Okay. Now, as for the impact on the US stock market, mainly the broader market, S&P 500, and now Dow Jones and the Nasdaq, in the short term, we would see increased market volatility. Now, uncertainty around which sectors face tariffs first leads to short-term swings. Defensive sectors like utilities, consumer staples outperform during uncertain periods. Now, tech stocks may decline due to potential retaliatory tariffs from China and the EU. In the medium term, corporates' earnings will be hit. Companies reliant on global supply chains like automakers, semiconductor firms, agriculture exporters will report lower earnings due to higher input costs. Now, the S&P 500 could experience a short-term pullback of 5 to 10% depending on the tariff severity. There will be a potential rotation into domestic-focused stocks. Why do I say that? Companies benefiting from tariffs, like US steelmakers, domestic manufacturing stocks could rally. Now, industrial and material sectors may outperform if domestic production gets a boost. Okay. What about the longer term then? Right? Market adjustments and supply chain shifts. So if tariffs, right, remain, companies may shift production outside of China to Vietnam, Mexico, or India. It can also bring it back to the US as well. So if Trump's tariff plans leads to renegotiated trade deals that remove or reduce tariffs, tech companies could regain lost market access and recover lost revenue. We have seen this before. A historical example of this happening is when Trump replaced North America Free Trade Agreement with the United States Mexico-Canada Agreement in 2020. Before the deal was signed, market uncertainty caused stocks to dip, Once the agreement was finalized, investors' confidence returned and the stock rebounded. So S&P 500 should recover. However, it may see slower growth in globally dependent sectors. What do you mean by that? Globally dependent companies are companies that depend on global trade, like Apple, Tesla, Boeing, could face ongoing challenges. Companies more focused on domestic demand, like utilities, real estate, US-based retail, might perform better in the long run. Okay. Now, this is based upon what we are seeing right now, the developments that we're seeing right now. Is this going to stay true for the next 3 months, next 6 months? We shall wait, until further announcement from Donald Trump and co. Okay, because we need to see, is he going to follow through, or is he going to say that, probably I'm not going to charge tariffs here, I'm going to reduce here, I'm going to reduce that. So these things can change, but for now, whatever it's shared over here is based on the current sentiment that we can get from the market. Okay, so definitely if I do see anything, I will update you guys as usual, right? And with this, that's the report for today. Let's move on to the chart.